Well, let's head back now out to Jackson Hole. Brian Cheung is sitting down with former Kansas City Fed President and former Fed Vice Chair Tom Hoenig. Brian.
Hi, Miles. So we're sitting down here, as you mentioned, with former Kansas City Fed President and former Vice Chair of the FDIC, long title, Thomas Hoenig. Thanks so much for joining us here today.
Glad to be with you today. Thank you.
So a lot's been happening. This is the first day of this symposium. You've organized previous symposiums in the past. The theme is challenges from monetary policy. What is feeling different maybe about this Kansas City symposium than in symposiums of years past?
Well, the main difference right now is that the topic is very timely for the times. We don't always get it that they don't always get it that close, but it's really quite important, I think, this symposium, because things are in such upheaval with trade wars going on, unconventional monetary policy, having to try and figure out how to deal with that going forward. So it's extremely important, this symposium, and not that others weren't as important in some ways, but this is particularly challenging right now. And so the speakers have been great, and I think it's a real opportunity to try and move things forward a little bit. So I'm very hopeful for it.
So one challenge that Fed Chair Jay Powell highlighted in his speech this morning was the leverage that we saw in the leading up to the financial crisis, what he described as one of the second big questions for monetary policy. You, especially in your role at the FDIC, were very focused on regulatory issues. And it raises the question, there are some that are worried that leveraged loans and buildup in the system right now, as a result of lower rates, could result in something bad. Do you feel comfortable with bank capital requirements right now, given that Jay Powell said, actually, I'm very comfortable with how the banks have been kind of improving their safety since the last crisis?
Well, I'm not as comfortable as he is. I will acknowledge that the levels of capital in the largest banks, particularly the ones that are systemic, has increased since the crisis. But they're still basically on a leverage basis about 6.5%. Losses during that crisis were more than 6% of their assets. So that's not, I mean, that's better than it was, but that's not really, the loss absorbing ability isn't as high as I think it should be. And there is a lot of leverage in this economy, and interest rates being this low is encouraging more leverage. So I think we need to be even better prepared than we are right now. But I'm at least pleased that we are twice as well capitalized as we were in the crisis. Small comfort in some ways, but better than nothing.
So when it comes to leverage, some have worried that given the recession risk right now, we saw the yield curve inversion in the last week or so, questions about what the next trigger might be, and some people have pointed to leveraged loans. Do you think it would be something that comes from the banking system, or would it be something outside the banking system, or even outside the U.S., that policymakers really should be considering as they continue future steps on moves?
Well, leverage is there, and I am aware of it and concerned about it, but I don't see that necessarily as the immediate critical problem. I think the trade uncertainties and the trade war uncertainties are really weighing on things right now, and that gives me more pause than the leverage itself. I don't take leverage for granted, but it's not right now at the front of my thinking.
On that point, Jay Powell also said that it's really tough, though, as a policymaker, to try to model in the impact of trade. It's not a variable that you factor into a Taylor rule or anything like that. So how should policymakers be thinking about it, especially given that some characterize the July 31st cut as an insurance cut, that we didn't need to wait for the data to turn before doing that?
Yeah, I don't know that I can speak to that, but I would tell you that you cannot anticipate that the trade war or the trade situation, how that will be resolved. But the problem is monetary policy can't solve every problem. It cannot solve the trade issue. So if you try and use it for a purpose that it is not prepared for, it's not useful for, then I think you buy future problems down the road. Now, if the economy slows and monetary policy can help facilitate getting through that, well, then I think they should, and they probably will, address it through monetary policy. But to think of that as the solution to the trade problem, I think is unwise.
Right. So switching gears back to regulation, the Volcker rule this week, we saw some finalization from some of the government agencies that pared back some of the post-crisis framework for that was put in place by Dodd-Frank. The accounting problem, I mean, without getting into the nitty-gritty, it's basically going to allow banks to have a little bit more flexibility in terms of the types of proprietary trading that they can do. Does that worry you? Are you comfortable with that change? How do you think?
I would have opposed that change. I think, the fact is that the Volcker rule is there for a purpose, and they keep saying, speculative trading with their own funds. Well, it's not their own funds. 94% of their balance sheet is borrowed, and so I don't consider that their funds as such. And so to allow them to trade, speculatively trade, to invest in hedge funds is outside of the intermediation process of commercial banks and draws fairly significant risk to it. And the Volcker rule had specifically designed to separate that out from deposit insurance and I think that should continue. And I'm for simplifying the Volcker rule by saying, you cannot do these things and we will check you. I don't think we need all this bureaucratic stuff in the middle, but that's different than rolling it back, and I don't think we should be rolling it back.
Well, I mean, we're still, more than 9 years out, I guess, from the creation of that rule, and still trying to figure out how to calibrate that thing.
How to calibrate it, and I think that's being used as an excuse to roll it back rather than simplify it.
Right. Lastly, there was another challenge about monetary policy that Jay Powell maybe didn't address, which is Fed independence. We've heard pretty unprecedented levels of criticism from the president even this morning in response to that speech. Is this I mean, you had a long tenure at the Kansas City Fed. How should Jay Powell react to this? And is the Fed really at a crisis point here in terms of credibility because of this?
Well, first of all, I think Jay Powell's doing a great job. I mean, he really is. He listens. He's very careful. I think the issue of independence is the Federal Reserve, central banks need to be insulated from short-term political whims. And that's what the founders of the Federal Reserve realized, and they put that into the structure of the system, and we should respect that. And so I think allowing Jay Powell, and especially the Open Market Committee, to deliberate carefully, to then explain themselves, and then be held accountable for that is how we should proceed, and we'll get the best outcomes. But yelling at them all the time and trying to get them to do things that aren't necessarily, in their judgment, the best things to do, I think is unwise.
All right. Well, former FDIC vice chair, former Kansas City Fed president, and currently at Mercatus in Washington, D.C., Tom Honig, thanks so much for joining us today.
Glad to be with you, and thanks for the invitation.
Thanks.
Bye-bye.
Miles, back to you.
All right. Brian Cheung there with FDIC vice chair, former FDIC vice chair, Tom Honig.